Okay, so someone hands you a gym tomorrow. A building full of equipment, a few thousand square feet of open floor space, a front desk, and a list of members paying a monthly fee just for the right to walk through the door. Sounds simple. Recurring revenue from people who mostly won't show up, paying you every month whether they use the equipment or not. That's the fantasy every gym owner eventually hears repeated back to them, and it's also the exact reason this business has one of the strangest, most misunderstood economic models in this entire series. The honest answer is that a well-run gym can be a genuinely durable, profitable business, and a poorly run one can bleed cash for years while looking from the outside exactly like its more successful competitor down the street. The first thing to understand is that a gym doesn't actually want most of its members to show up regularly. And this is the single most important fact about the business model that almost nobody outside the industry fully appreciates. A typical gym membership costs somewhere between $10 and $60 a month, depending on the market and the tier of facility, and that pricing only works financially because the vast majority of members attend far less often than they imagine they will when they sign up. Industry data has consistently shown that a large share of gym memberships go essentially unused for months at a time, sometimes never used at all after the first few visits, and this isn't a flaw in the business model, it's the entire foundation of it. A gym is built with enough equipment and floor space to comfortably handle maybe 10 to 20% of its total membership showing up at any given time, not because the owner is trying to cut corners, but because if every single paying member actually showed up simultaneously, the facility would need to be 5 or 10 times larger than what the membership fees could ever justify building. Let's talk about what it actually costs to open a facility like this, because the capital requirements vary enormously depending on the format you're building. A large-scale gym with a full range of cardio and strength equipment, locker rooms, and possibly a pool or group fitness studio space can require anywhere from a few $100,000 to several $1 million in build-out costs, covering leasehold improvements, equipment purchases or leases, and the specialized flooring, plumbing, and ventilation. A fitness facility requires beyond a standard commercial space. A smaller boutique studio format, focused on a single class type, has meaningfully lower build-out costs, but also a much smaller potential membership base per location, meaning the economics depend on charging considerably higher per member pricing to make the smaller footprint work financially. Either way, before a single member walks through the door, you've committed enormous upfront capital to a lease and equipment that only becomes profitable once you've accumulated enough members paying recurring fees to cover your fixed costs. Here's where the real economics of this business live, in the gap between your fixed costs and your membership base, and it's a considerably thinner margin business than people assume from the outside. Rent, equipment financing or lease payments, utilities, and staffing represent largely fixed costs that don't meaningfully change whether you have 500 members or 2,000. Which means the entire profitability of a gym depends on how many members you can sign above the break-even point your fixed costs require, and every member signed above that break-even line drops almost entirely to profit because the marginal cost of one additional member showing up occasionally is close to zero. This is exactly why the industry has built its entire growth and marketing strategy around member acquisition volume rather than member utilization, because a gym owner's actual financial interest is maximizing the number of people paying the monthly fee, not maximizing how often any individual member actually uses the facility. Now here's the anchor risk specific to this business, and it doesn't come from a single dominant customer the way it has throughout most of this series. It comes from churn, the rate at which existing members cancel their memberships every month. Gym membership churn runs considerably higher than most recurring revenue businesses, driven by the well-documented gap between fitness intentions and actual sustained behavior, meaning a gym has to continuously acquire new members simply to replace the ones canceling. A treadmill dynamic, quite literally, that requires ongoing marketing spend and sales effort just to maintain a stable membership base. let alone grow it. This creates a business where customer acquisition cost becomes one of the most important numbers on the entire balance sheet. Because a gym that can acquire members cheaply relative to their typical membership duration can sustain healthy margins even with high churn, while a gym spending heavily on acquisition without retaining members long enough to recoup that cost can look busy and popular while actually losing money on every new sign-up. Here's a case study that shows how this plays out at the extreme end of the industry. Some of the largest low-cost gym chains in the country have built their entire business model explicitly around this churn and utilization dynamic, offering extraordinarily low monthly membership prices, sometimes under $15 a month, specifically because their financial model assumes and even depends on a large share of members rarely or never showing up. These chains have openly discussed in industry commentary that their profitability actually improves when membership signups exceed what their physical facilities could comfortably handle if everyone attended regularly. Because the low price point attracts an enormous volume of members primarily motivated by good intentions rather than consistent attendance. And the resulting revenue from a large base of largely inactive members, paid every month with minimal marginal cost to the gym, funds a facility that would be financially unsustainable if it depended on heavy, consistent usage from its full membership base. There's also a contract and cancellation dynamic worth understanding, because gyms have historically relied heavily on longer-term membership contracts and cancellation friction, requirements like written notice periods, in-person cancellation requirements, or early termination fees, specifically to reduce the churn rate that would otherwise erode profitability considerably faster. This practice has drawn persistent consumer complaints and, in some jurisdictions, specific regulatory attention requiring gyms to make cancellation processes considerably easier than the industry historically preferred. And gyms operating in regions with stricter cancellation regulations have had to adapt their financial models to assume higher churn rates than gyms operating in less regulated markets, because members who can cancel easily and immediately tend to do so more readily than members facing genuine friction in the cancellation process. Staffing this kind of business looks different from the specialized technical labor challenges covered elsewhere in this series because the core staffing need, front desk personnel, personal trainers, and group fitness instructors, doesn't require years of specialized technical training the way precision manufacturing or offensive cybersecurity work does. But this same accessibility creates its own competitive dynamic, personal training services, which represent a meaningfully more profitable revenue stream than basic membership fees alone, depend heavily on retaining trainers who've built genuine client relationships, and a gym that loses a popular trainer to a competing facility or to the trainer starting their own independent practice can lose not just that employee, but a meaningful share of the client relationships and recurring personal training revenue that employee had built up over time. There's also an ancillary revenue dimension worth understanding, because base membership fees alone often generate margins thin enough that the most profitable gyms have built substantial additional revenue streams on top of them. Personal training sessions, group fitness class add-ons, retail sales of supplements and apparel, and in some larger facilities, childcare services or spa amenities all represent revenue that carries considerably better margins than the base membership fee itself, because these additional services can be priced closer to their actual value to the specific members who want them, rather than the heavily discounted, volume-driven pricing that base membership requires to remain competitive. Gyms that successfully convert a meaningful share of their membership base into buyers of these higher-margin ancillary services often achieve considerably better overall profitability than gyms relying purely on base membership fees, which has pushed many operators to treat the membership fee itself almost as a loss leader, a mechanism for acquiring a large base of potential customers who can then be upsold into the genuinely profitable ancillary services layered on top. Real estate and location decisions carry outsized importance in this business relative to many of the other industries covered in this series, because unlike a business that can serve customers remotely or through delivery, a gym's membership base is fundamentally constrained by geographic proximity. Most members won't travel more than a short drive or walk from their home or workplace to attend regularly. This makes location selection one of the most consequential decisions a gym owner makes, requiring careful analysis of local population density, income levels, and existing competitor saturation, because opening in a location with insufficient nearby population to support your required membership base, or in a market already saturated with competing gyms fighting over the same limited pool of potential members, can doom a facility's economics regardless of how well it's otherwise operated. Lease terms add another layer of risk specific to this business, because gyms typically require long-term leases, often 10 years or more, to justify the substantial build-out investment required, which means a gym owner is making a location bet with limited ability to relocate if the surrounding market changes considerably during the lease term, whether through new competitor openings, changes in the local population, or broader economic shifts affecting discretionary spending on fitness memberships in that specific area. The answer depends on a small number of variables that matter more here than the fitness equipment or facility quality most people assume drives success. You need a membership acquisition cost genuinely lower than the lifetime revenue an average member generates before churning, because in a high-churn business, getting this ratio wrong means growing your membership base while simultaneously losing money on every new sign-up. You need to price and design your facility capacity around realistic utilization assumptions rather than the fantasy of full attendance, because a facility built for consistent heavy usage from every paying member would require membership pricing far higher than most markets can actually support. And you need genuine discipline around member retention and satisfaction for the smaller share of members who do attend regularly, because those consistently active members are disproportionately likely to notice facility quality issues, equipment maintenance problems, or overcrowding, and are also the members most likely to generate the word-of-mouth referrals that keep acquisition costs manageable. In the optimistic scenario, you build a membership acquisition funnel considerably cheaper than your average member's lifetime value. Maintain facility capacity calibrated realistically to actual expected utilization, and build genuine loyalty among your most active members that keeps acquisition costs low through referrals. In the pessimistic scenario, you spend aggressively to build membership volume without adequately tracking retention. Discover your churn rate quietly erodes any acquisition efficiency you thought you had, and find yourself running a facility that looks perpetually busy with new signups while actually losing money on the membership base as a whole. The equipment was never really the business. The treadmills, the weight racks, the locker rooms, all of that is simply the physical space that makes the recurring membership fee feel justified. What actually determines whether this company survives is a math problem almost nobody joining a gym ever thinks about. Whether you can keep the cost of replacing canceling members lower than what those members were worth while they stayed. In a business quietly built on the fact that most of your paying customers, thankfully for your margins, aren't actually going to show up very often at all.